When starting a new business, one of the most important decisions you'll make is choosing the right business entity. The type of entity you choose will have significant legal and tax implications. This article will explore the differences between an LLC, C Corp, and S Corp, and provide examples to help you understand which entity might be best for various types of businesses, from real estate to IT professionals, manufacturers, and companies looking to raise funds. LLC, or Limited Liability Company. An LLC is a flexible business entity that provides limited liability protection to its owners, known as members. This means that members are generally not personally liable for the company's debts and liabilities. An LLC can be taxed as a sole proprietorship, partnership, C Corp, or S Corp, providing flexibility in how profits are distributed and taxed. Ideal for real estate businesses. LLCs are often preferred for real estate investments because they provide liability protection and allow for pass-through taxation where income is taxed only at the member level. Small to medium-sized businesses. Many small business owners, such as local retailers, service providers, and consultants, choose LLCs for their simplicity and flexibility. Example: imagine you're starting a real estate investment company. You buy a property and rent it out. By forming an LLC, you protect your personal assets from potential lawsuits or debts related to the property. Additionally, the rental income is only taxed once at your personal income tax rate, avoiding the double taxation that corporations face. C Corporation. A C Corporation is a separate legal entity from its owners, providing the strongest protection against personal liability. C Corp can have an unlimited number of shareholders and can issue multiple classes of stock. This makes them attractive for businesses looking to raise significant capital or go public. Ideal for manufacturers. Businesses with high revenue potential and significant liability exposure often choose C Corp for their strong liability protection and ability to raise funds. Companies looking to raise funds. Startups planning to seek venture capital or go public typically form C Corp to attract investors and facilitate stock issuance. Example: you're starting a tech startup and plan to raise money from investors. By forming a C Corp, you can issue shares of stock to investors, making it easier to attract capital. The company's profits are taxed at the corporate level, and any dividends distributed to shareholders are taxed again at the individual level, resulting in double taxation. However, the ability to raise significant funds and the strong liability protection outweigh this drawback for many high-growth companies. S Corporation. An S Corporation is a special type of corporation that allows profits, losses, deductions, and credits to pass through to shareholders' personal tax returns. This avoids the double taxation faced by C Corp. However, S Corp have several restrictions, such as a limit of 100 shareholders and only one class of stock. Ideal for professional services. IT professionals, consultants, and other service-based businesses often benefit from the tax advantages of an S Corp. Small businesses with growth potential. Businesses that expect moderate growth and want to avoid double taxation may choose an S Corp. Example: you're an IT professional starting a consulting business. By forming an S Corp, you can pay yourself a reasonable salary and take additional profits as distributions, which are not subject to self-employment taxes. This can result in significant tax savings compared to an LLC or sole proprietorship. Additionally, you avoid the double taxation that a C Corp faces. Comparing LLC, C Corp, and S Corp. Let's look at a few scenarios to understand when each entity might be the best choice. Scenario 1. Real estate business. LLC. Best choice due to liability protection and pass-through taxation. The flexible structure allows for easy distribution of rental income. C Corp. Not ideal due to double taxation and lack of flexibility in profit distribution. S Corp. Could be beneficial for a small real estate business looking to avoid self-employment taxes on a portion of income. Scenario 2. Tech startup. LLC offers liability protection but might not attract venture capital as easily due to tax complexities. C Corp. Ideal choice for raising capital and potentially going public. The ability to issue stock is crucial for attracting investors. S Corp. Not suitable due to restrictions on the number of shareholders and types of stock. Scenario 3. IT consulting business. LLC provides liability protection and flexible taxation options but may result in higher self-employment taxes. C Corp. Not ideal due to double taxation and complexity. S Corp. Best choice for tax savings on self-employment taxes while maintaining liability protection. When S Corp election is justified. Electing S Corp status can be advantageous in several situations. Reducing self-employment taxes. If you're a business owner who takes home significant profits, electing S Corp status can help reduce self-employment taxes. By paying yourself a reasonable salary and taking additional profits as distributions, you can lower your overall tax burden. Avoiding double taxation. S Corp avoid the double taxation faced by C Corp, making them attractive for small to medium-sized businesses with growth potential. Maintaining liability protection. S Corp provide the same liability protection as C Corp and LLCs, shielding your personal assets from business liabilities. Example, you run a successful marketing agency with $200,000 in annual profits. By electing S Corp status, you pay yourself a $100,000 salary and take the remaining $100,000 as distributions. This way, you only pay self-employment taxes on the $100,000 salary, potentially saving thousands in taxes compared to an LLC. Timing considerations. LLC or C Corp to S Corp conversion. One strategic approach is to initially form your business as an LLC or C Corp and then convert to an S Corp when it becomes advantageous for tax savings. This conversion can be done under specific IRS guidelines and timing to maximize benefits. Conclusion. Choosing the right business entity depends on your specific business needs, growth potential, and tax considerations. LLCs offer flexibility and liability protection, making them ideal for real estate businesses and small to medium-sized companies. C Corp provide the strongest liability protection and are best for companies looking to raise significant capital or go public. S Corp offer tax advantages by avoiding double taxation and reducing self-employment taxes, making them suitable for professional services and growing small businesses. For personalized advice on choosing the right entity for your business, consult with a qualified CPA. For legal considerations, it's crucial to consult with an attorney to ensure all legal aspects are properly addressed. For more details, contact Manan Kothari CPA at www.manankothari.com.